Hello viewers, we'll be going over gold miners, ETF ticker symbol, GDX. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for the gold miners. So back to the technical analysis, we're up around 4% on the 1 hour chart. We are now approaching to overbought RSI. We were approaching to negative MACD, however overnight we start to see a convergence. And on the 4 hour chart, we are also nearing overbought RSI, and we were on a divergence point on the MACD. However, we start to see a reversal and converge upward. If we expand out further on the daily chart, we are start seeing a sideways movement on the daily MACD, and it's in favor to the upside, and at the moment we're also nearing overbought RSI as well. And if we expand out further on the weekly chart to see multi-year resistance, I do see a resistance around the price of $38 that dated back all the way to March 11, 2013. And if we do manage to hit that resistance point, that price movement to the upside is roughly around less than 3% to the upside. And if we expand or were to reverse and find support, the next support level that I see will be around the 18-day moving average, this purple line, and that is around the price of $34. And if we were to touch that support level, that price movement to the downside, it is roughly around, let's see, it is only roughly around 9% to next support level. And let's head back to the day-by-day probability model. Again, these models are now available in the link below, so do check it out. So as the days progress to the 7th day, we have a favor to the downside on 50% chance for gold miners to fall between 0 to 2.5%, and on the extreme case, we have a 50% chance for gold miners to fall between 5 to negative 8%. Again, these 50% chances, it's based on only 2 models, so the sample size is small, so do take that in consideration, so it's not statistically significant. So let's examine the day-by-day forecast for the gold miners. So we observe 1 day out, that will be Wednesday, 2 days out would be Thursday. So 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. We have our current trend as a blue line here, and overlapping it is the best match to the current trend at the moment. And that trend dates back to June 4th to August 28th, 2013. And up here we have our current trend, so let's compare the 2 trends. So what we have here is we start off at the middle Bollinger Band. We proceeded to dip lower to touch the bottom Bollinger Band first. We'll reverse higher to touch higher highs. So in all 3 instances, we touch the upper Bollinger Band. And now let's examine the trend in question. We first start off at the middle Bollinger Band, first touch the bottom Bollinger Band. In this case, we touch the upper Bollinger Band, and then we continue to make higher highs. But in this case, we did not quite touch the upper Bollinger Band. And one thing to note, among the 2 trends, we did not, between these 2 upper Bollinger Bands, we did not revert back to mean to the middle Bollinger Band as we saw on the trend in question. So do keep that in mind. So what we have here is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's a reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly same. And the models are similar but not identical, so do keep that in mind. So let's examine the forecast for the trend that we just examined. We just examined June 4th to August 28th, 2013. Back then, gold miners fell roughly around 2.5%. And if we examine the day-by-day probability model, that coincides with this standard deviation of 50% chance between 0 to negative 2.5%. So let's examine closer on the technical performance of each model. On our current trend that we're in, we're roughly around 0% from monthly high. We're up 4.9% from monthly low, up 6% from 10 simple moving average, up 8.3% from 20 simple moving average, and up 27% from 50 simple moving average. And now let's examine the trend that we observed. Back then, it was down roughly around 7% from monthly high, up 21% from monthly low, down 4% from 10 simple moving average, up 1.5% from 20 simple moving average, and up 8% from 50 simple moving average. So there are technical differences among the two trends. One, observing the distance between the monthly low. On the current trend, we're much further away from monthly low than what we observed, and also the 10 simple moving average on the trend in question was a negative 4%. Compare that to up 6% from 10 simple moving average. And there are wide gaps in the positive side of the moving averages here as well. So do keep that in mind. Again, these models are now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.